American factories are going dark. Job losses are mounting month after month. Yet in Beijing, container ports are overflowing with record profits. $322 billion in exports in a single month. The United States thought tariffs would cripple China, but instead, BRICS is raking in gold, dumping U.S. debt, and seizing new markets from Africa to Europe. And now, Treasury Secretary Scott Bessent is openly calling on Europe to help collapse Russia's economy, even as America's own consumers buckle under rising prices. This isn't a trade war anymore. It's a global power shift playing out in real time. Factories across Ohio and Michigan sat idle as another round of layoffs hit American workers. At the same time, Chinese ports reported record container throughput, with the Ministry of Commerce confirming in August 2025 that exports totaled $322 billion, up 4.4% from a year earlier, despite a collapse in shipments to the United States. According to Reuters on August 12th, exports to America plunged by 33%, the sharpest decline in 6 months. Yet Chinese exporters compensated almost instantly by rerouting goods to Southeast Asia, Africa, and parts of Europe. The imbalance captured a larger crisis. Washington's tariffs were draining U.S. consumers while Beijing was booking profits at scale. The U.S. jobs market reflected the strain. The Labor Department's July 2025 report showed that non-farm payrolls contracted for the fourth consecutive month, the first such stretch since the global financial crisis. Manufacturing accounted for the steepest losses, with steel and aluminum producers cutting more than 40,000 positions. The Financial Times noted on July 31st that hiring in hospitality and retail also slowed sharply as consumers scaled back spending under higher prices. The hypothesis that tariffs would protect American industry faced contradictory evidence. The data pointed to an across-the-board weakening of employment. Treasury Secretary Scott Bessent insisted the strategy remained justified. On NBC's Meet the Press in early September, he argued that tariffs were strengthening fiscal balances, pointing to Treasury receipts. Yet Goldman Sachs analysts had published a study in May estimating that 86% of tariff costs were borne by U.S. businesses and households. The contradiction was clear. If tariffs were a fiscal tool, they doubled as a consumer tax. The administration dismissed that interpretation, but honestly, the numbers suggested otherwise. Markets began pricing in long-term consequences. Yields on 10-year treasuries edged above 4.3% in mid-August, according to Bloomberg data, the highest level in more than a decade. Demand from foreign buyers weakened sharply. The IMF's July reserve composition report showed China cutting its holdings of U.S. bonds for the 10th consecutive month, bringing its stockpile below $800 billion, the lowest since 2009. Russia had already exited U.S. debt markets years earlier, and India's purchases slowed to a trickle. If BRICS members continued this trajectory, their combined share of treasuries could fall under 10% by the end of Trump's term. Inside China, energy costs gave exporters another advantage. Reuters reported on July 18th that industrial power tariffs in Tianjin and Guangdong fell by 24% year-on-year, a result of abundant coal supplies and rapid solar expansion. Russia's gas pipeline deliveries added further downward pressure. Cheaper energy directly translated into lower factory costs, allowing Chinese firms to undercut Western competitors. The hypothesis that tariffs alone could offset this cost gap struggled against the evidence energy and scale were driving China's competitiveness beyond Washington's reach. Meanwhile, BRICS coordination deepened. At the July virtual summit, Brazil's finance ministry issued a statement declaring that tariff blackmail was destabilizing global markets. China echoed the warning, with Vice Commerce Minister Guo Ting arguing that no country can afford to retreat into self-imposed isolation. These were not rhetorical flourishes. They were markers of policy alignment. The bloc pledged to expand bilateral settlements in local currencies. By August, Indian refiners were settling more than 40% of Russian crude purchases in rupees, according to the Reserve Bank of India. Such moves signaled de-dollarization not as ideology, but as transactional practice. Bessent escalated pressure in response. In late August, the Treasury confirmed 50% tariffs on Indian goods, citing ongoing oil imports from Russia. The Wall Street Journal reported on August 25th that these were among the highest tariffs imposed on any U.S. trading partner in modern history. India, however, responded by reaffirming its participation in BRICS energy projects. Rather than isolating Moscow, Washington appeared to be pushing New Delhi deeper into alternative networks. The logic of the strategy was questioned even within U.S. policy circles. If punitive tariffs alienated allies, were they achieving their intended aim? Trade diversion was measurable. Africa emerged as one of China's fastest-growing markets. The Financial Times reported on August 22nd that China's trade surplus with the continent reached $60 billion in the first half of 2025, surpassing all of 2024. Solar panel exports alone surged 60% year-on-year. Goods once destined for American retailers were now driving African infrastructure. The hypothesis that U.S. tariffs could restrict China's global reach was undermined by the adaptability of Beijing's exporters. China's surplus is translated into liquidity for strategic accumulation. The People's Bank of China disclosed in its August bulletin that national gold reserves rose for the 10th consecutive month, reaching 74 million ounces. Bloomberg highlighted that 1.2 million ounces were added since November 2024, the longest continuous buying streak in decades. This aligned with a broader pattern. The World Gold Council reported that global central banks purchased 290 tons of gold in the second quarter of 2025, the largest quarterly total since records began in 2000. If diversification away from the dollar was the goal, the evidence was accumulating that Beijing and its partners were executing it systematically. The dollar itself weakened. By early September, the DXY index fell below 100 for the first time since 2022, down 7% from its April peak. Gold simultaneously climbed to $3,550 an ounce, Reuters noted on September 3rd. Investors were not merely reacting to tariffs, but to the perception that U.S. assets carried growing political risk. If reserve managers in emerging markets shared that view, demand for Treasuries could continue to erode regardless of Washington's defense. Bessent framed the issue as a race. In the same NBC interview, he declared, "We are in a race now between how long the Ukrainian military can hold up versus how long the Russian economy can hold up." The phrase underscored Washington's calculus: sustain pressure until Moscow concedes. Yet applying that framework to BRICS raised questions. If sanctions and tariffs also pressured India, Brazil, and China, would the bloc fragment or consolidate? So far, the evidence leaned toward consolidation. The U.S. court system introduced another variable. In July, the U.S. Court of Appeals for the Federal Circuit ruled that the administration had overreached by imposing sweeping tariffs under emergency powers. Only Congress, the court argued, could authorize such measures. The case moved toward the Supreme Court. If the ruling were upheld, the Treasury would need to refund half the tariffs collected, Bessent admitted, calling it terrible for fiscal stability. The paradox deepened. A strategy justified as fiscal strength could itself trigger budgetary strain if judged unlawful. Corporate data reinforced the stress. The Wall Street Journal on August 29th reported that Walmart warned of higher prices for key goods due to tariffs, while Caterpillar projected a 15% decline in overseas machinery sales tied to retaliatory measures. By contrast, Chinese industrial firms posted record margins. The National Bureau of Statistics in Beijing confirmed in late July that profits of large manufacturing enterprises rose 17% year-on-year in the first half of 2025. In a symmetrical pattern, U.S. firms were squeezed while Chinese rivals expanded. Technology trade followed a similar track. Semiconductor exports from South Korea to China rose 11% in the second quarter, according to customs data published in June. Analysts at Morgan Stanley argued that China was capturing downstream value by integrating these inputs into finished goods for re-export. The idea that Western supply chain decoupling would isolate Beijing was contradicted by evidence of continuing integration, albeit through regional intermediaries. In financial markets, U.S. equities reached record highs even as the labor market stumbled. The S&P 500 climbed 8% in August, Bloomberg reported, powered by energy and defense stocks. Bessent cited this as proof of resilience. Yet critics noted that equity performance did not offset payroll contraction or bond market fragility. The coherence of using stock indices as a metric for tariff success was questionable when juxtaposed with broad labor market weakness. As the trade war lengthened, secondary effects multiplied. Tourism flows to the United States fell 12% in the first half of 2025 compared to a year earlier, according to the Department of Commerce. Chinese visitor numbers dropped nearly 40%. Universities reported declining enrollments from BRICS nations, threatening tuition revenue. These were not marginal sectors. They represented billions in services exports. The hypothesis that tariffs targeted only goods overlooked the services side of the balance sheet, where losses were compounding. The broader historical context mattered. IMF research published in June emphasized that tariff wars typically reduce global output rather than shifting it. Their modeling suggested that by 2026, U.S. GDP could be 1.2% lower than baseline if current policies persisted, while China's GDP would remain largely unaffected due to trade diversification. If correct, the forecasts implied asymmetry. Washington absorbed losses while Beijing distributed its risk. By late summer, Bessent's frustration was evident. His remarks about collapsing Russia's economy by partnering with Europe revealed the scale of ambition. But European responses were cautious. The Financial Times on August 20th reported divisions within the EU, with Germany reluctant to jeopardize manufacturing exports. If Europe wavered, Washington's ability to orchestrate a coordinated squeeze would diminish. Against this backdrop, China's August trade surplus exceeded $100 billion, the largest monthly figure ever recorded according to Reuters. That surplus represented not just numbers on a ledger, but potential capital for further gold purchases, infrastructure investment, and currency diversification. The hypothesis that tariffs could weaken Beijing met its starkest counterpoint. Profits were rising even as U.S. trade flows collapsed. The more Washington pressed with tariffs, the more BRICS members adjusted, rechanneled, and in some cases strengthened their positions. The United States appeared locked into a strategy that strained its own consumers, alienated partners, and accelerated the very de-dollarization it sought to prevent. The final question may not be whether tariffs succeed or fail, but whether they trigger a structural reversal in global finance. If BRICS reserves in Treasuries fall under 10%, if gold becomes the settlement backbone, if Africa and Asia deepen ties with Beijing's exporters, the United States could face a scenario it has not confronted in generations, a world trading system that grows stronger without it. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.